roughly a century or so ago in the United States, there was more money bet in U.S. presidential election betting markets than there was in the stock market at the time.
A federal judge overruled Trump's tariffs, and now the market is left waiting for a ruling from the Supreme Court. Meanwhile, Trump is trying to fire a Fed governor, all while pushing for interest rate cuts, which are expected later this month. Markets hate uncertainty, and it seems that we have run into a lot of it lately. Hello, and welcome to Milk Road Macro, the podcast that isn't afraid to ask if the Supreme Court wants to just join the FOMC too, because at this point, why not? I'm your host, John Gillen. Today is Monday, September 1st, and today we are joined by the illustrious Professor Robin Hanson. Professor Hanson is an economist, author, and many other things. He serves as the Associate Professor of Economics at George Mason University and was previously a research associate at the Future of Humanity Institute at Oxford University. He holds degrees in social science, physics, philosophy, maybe a bunch of other things. I don't even know. He does everything. And he is perhaps best known for his pioneering work on prediction markets. I'm going to have Robin predict the future for us and tell us everything we need to know about the market. So if that sounds good to you, make sure that you like and subscribe. Share this episode with someone who would enjoy it. And as a reminder for our listeners on YouTube, make sure you hit the like button, the subscribe button. Our podcast listeners, a 5-star rating and review would mean the world to us. It really helps us grow the channel and get this great content and educational material out to more people. And as a reminder, today's episode is brought to you by our wonderful sponsor, KGeN, the verified distribution protocol changing the growth game. And without further ado, welcome to Milk Road Macro, Professor Robin Hanson. How are you, sir?
Great to be here. What should we talk about?
Well, that's what we're going to have to figure out, I guess, between the two of us. Look, I think a good place to start, something that's on a lot of people's minds. There was a federal judge who recently overturned President Trump's tariffs policy. Now we're going to wait, it looks like, for a long time on a ruling from the Supreme Court. The legal system moves very slowly. By the time this gets to an adjudication, there could be trillions of dollars at stake one way or the other on this. What do you see happening here? What do investors need to know? And how do you think the markets are going to digest all of this?
Okay, so for framing, I specialize in thinking about the big picture over the long run. And so far, I don't specialize in thinking about short run, very specific things that happen. So I'm going to mainly try to put short run things in the larger context.
That's totally welcome. It's called Milk Road Macro. The big picture is always welcome.
So first, as an economist, I got to say, we economists are not too big on tariffs. Tariffs just look to us like mostly a mistake. And that's what I got to say as an economist. But this is in the larger context of Trump and anti-Trump, which is, this huge cultural fight today. And clearly part of Trump's shtick has been that he's not the usual sort of, president with the usual sort of policy things. He's going to defy the usual frameworks. He's going to defy the usual, restrictions and, constraints. He's not just like going with the system and doing what it says. So this does fit his brand, right? He is going with his brand by saying, there's this other thing, other people say it's bad, but I say it's good. And let me show you what I can do. And of course, it goes with his deal brand, right? One of his main brands is, hey, I can make deals. And other people just don't make so many deals. And I'm going to make the world different as president with my deals. And so he's trying to do that with peace, right? With Ukraine, et cetera. And he's trying to do that with tariffs. That is, he says, I'm art of the deal guy. I'm going to do deals. So it makes sense that this is the sort of thing he's doing. But, he is putting more weight on this than other things you might have thought he'd do. But it does fit his brand. And from the economist's point of view, you have to say, overall, it's not going to go that well. But it could solidify people behind him. If it doesn't go too badly, maybe the people on his side will say, yeah, we elected a guy who's going to do something different. He did something different. All right. Then they like him for it. And he goes on and, Vance becomes the next president, et cetera. This could go kind of well for him in the long run if he doesn't screw it up too badly, right? There's a potential to screw this up pretty badly because tariffs can hurt things a lot, but he might not, right? So, and it's working for him and his brand.
This is an interesting point. And I think, obviously the larger cultural, arm wrestling match that we're living through is part of this, but there has been a lot of uncertainty that's been created by the kind of radical policy changes he's made. There's also opportunity there. So I think you're kind of right. He either, ends up on Mount Rushmore or somewhere else. But look, let's pivot to something that I think is a little bit more in your wheelhouse.
Just one more thing on this. If he manages not to screw this up and get more support, that might mean he can do other things he wants to do.
Sure.
So, whether or not this goes especially goodly or badly is like a entry. I mean, we saw the dodge at the beginning trying to do lots of big things, and that seems to be cut back. But there's a potential clearly for Trump to do a lot more bigger things than he did in his first term, even if tariffs go badly, for God's sake. So that's part of the big bet here is where else will Trump go to try to do big things? Could he make a deal with Social Security to reform it, right? I mean, what sort of big deals could he be trying to make?
All right, well, let's not go throwing around. Let's not give him any crazy ideas here. But well, this is part of what I want to kind of keep this conversation going, because seeing what happens next and following these major trends is really important, I think, for investors to do. And it's not so much dogmatic about what must happen or what will happen, but just seeing what does happen and what might potentially come on the horizon. I want to pivot to prediction markets, because I think our audience is particularly interested in the rise and popularity of prediction markets. Your work for many years has focused on these. Tell us just a little bit about how you initially got interested into the subject of prediction markets, and why are prediction markets so important and such a powerful tool?
There was a time before there was a World Wide Web. You might not know that or remember that, but there really was a time way back in the, around 1990 or so, when there wasn't a World Wide Web. And I was then involved with a group of people who were envisioning the World Wide Web and what it could be and where it could go. And in the process of digging into that, I came to doubt more that the World Wide Web could achieve the hopes we had for how it could reform society and make everything better. And so I was looking for something different that could achieve similar goals. And because most of the people I was hanging out with were kind of rabid libertarians, the idea of betting markets was accessible to me. And so I thought, well, could we use betting markets to solve many of our social problems? Many of our social problems being, we don't know what to do. We don't know what our problems are. We don't know which policies would be effective. And then it looked like, oh, well, betting markets could address that. That is, you had a betting market on a policy question, a big question, then the odds would be a good consensus on that. And so I started to think about and talk about how could we use betting markets much more than we had to address big, important questions in our world. And so I started to do that in the, around 1990, so 35 years ago now. And then, in the next, decade, there started to be this burst of prediction market activity in the United States in the aughts. And there were a number of companies doing this and experimenting with this. And so I was involved then with, advising and helping people try things. And the key idea is that we've had speculative markets for centuries whose main function is to hedge risk. As many of your presumably viewers here are very well aware, most people think of the main function of financial markets as hedging risk. They have a side effect of generating information, but we don't tend to think of generating and creating a market and sustaining it for the purpose of the information. But the new idea here is, if you want to know, say, if your project will make its deadline, you make a speculative market on that, and then the odds right there tell you, will you make your deadline? And you can then do things to, based on that information.
Right.
So it doesn't have to be a large market. It doesn't have to have a lot of money involved in order to aggregate the information of the participants. And so it looked like a promising mechanism for society, not just that, but many organizations which have issues like what products to produce or what projects to work on and continue with. And so there seemed to be this potential for informing organizations by their purposely making betting markets the topics they cared about.
Gotcha. So the benefit of markets is not just financial return or hedging out risk, but there's also a informational element to a marketplace, and that can be used to help drive decisions. I've seen a lot of research that says that prediction markets are actually oftentimes much more accurate than experts. We've seen this in elections and so forth recently. Why do prediction markets so often beat expert predictions? What makes them so much more powerful and accurate than experts on these things?
So the main thing to say is, as an economist, I'm a professor of economics, we know a lot of things, and people in finance know a lot of things about how financial markets work and why they are accurate. But the main reason that you should be interested is we just have this empirical literature that says when we systematically compare financial market prices to anything else at the same time, estimating the same thing with anything remotely comparable resources, the prediction market is either about the same or substantially better. That's the empirical fact, and that's the main reason I would recommend it to you. Now, you're curious and you think, why? And then I can tell you why in part. So one reason is just you have this straightforward financial incentive. If you see a price and you think it's wrong, you expect a profit by fixing it. So that's, as with all financial markets, an incentive to, correct errors and add information. But more than that, it's not just that base information. It's looking at any biases in the process. So if you look at the process of prices in the past, and you find any sort of bias, any pattern whereby you could have predicted things better than the price did at the time, you're empowered to use that to make money. So this is a process whereby people come in what they know and they try to, use it to make money, but that could have all sorts of errors and biases. But if you can find any error or bias in that process, you can fix that by betting on that. So it's a way that it corrects for its own biases. And in addition, if you think but you're wrong, this process teaches you to shut up and go away. Which is a problem with all the rest of our institutions in the world, including podcasts and everything else. There's a lot of people out there who don't know what they're talking about, but they keep talking. And it's hard to make them shut up and go away. But prediction markets have this nice, clear signal. You think you know something, you trade and you just keep losing money. Soon after you go, I guess I don't know as much as I thought. And you go away.
This is going to be a great conversation. I'm enjoying this a lot, Professor. Okay, I appreciate that. I think that what you're saying is that it educates people who have incorrect information, and it rewards people for, if they have correct information or they know better than the market, it rewards them and incentivizes them to contribute that information and to correct that in the marketplace. I'm really curious your thoughts on what makes so many people so uncomfortable about the idea of prediction markets, because it's taken a really long time to get these to become more mainstream. I don't want to go too much down a rabbit hole on this, but this was a really interesting anecdote because you have a long history in this. You'd worked with DARPA on a prediction market for some sort of counterterrorism thing, and were accused of creating gambling markets for betting on terrorist attacks and all kinds of things like this. What is the driving thing behind all this pushback against and resistance to prediction markets and the benefit that they could offer to society?
So our world is full of social institutions and it's full of talk. We're talking right now, and the world does a lot of talking, and almost all of our institutions are full of talking. So we have, churches, and we have firms, we have government, and in all these places, we've got people in roles who have responsibilities, supposed to make choices, and they have some incentives. They get promoted or fired, and they're just talking to each other all the time. And we're pretty comfortable with the idea of people talking. Maybe they could lie, maybe they are telling the truth, and using all sorts of ways to judge who should be in what role and who do we trust based on what we've heard them say and who's talked about them and what sort of credentials they have in terms of education or other sorts of prestigious backgrounds. That's our world to a large extent, is organizations, individuals making choices in the context of prestige, credentials, education, all based on talking. Education is almost entirely based on talking. Most prestige is based on talking. People of the New York Times or people who have government, positions, etc. It's all really based on people talking, people judging what other people say, people saying who's impressed with people talking, and then promoting people and firing them, all based on all this talk. Our world is full of stuff that happens in a world of talk about it. And we know talk can have many problems, but this is the world we're comfortable with. And when you think, oh, what if we used betting markets in that world to replace some of this talking? Well, first of all, that's jarring, okay? It's like this alien thing coming into this world of familiar. It's like, you have porpoises and other nice mammals in the ocean. Then you got octopi. What the hell is this octopi thing? It seems really strange to include an octopi among all the familiar mammals or something. And then we know that prediction markets and financial markets, money's involved very explicitly. And the fact that money is so prominent and forward makes us a bit uncomfortable. Not like we know in all this world of people with jobs and positions and talking, money is heavily involved, but we suppress it into the background. And we kind of pretend that money is only, a consequence and side effect of the talking. And here in the betting markets, the money is directly driving these prices, and without talking being the intermediary. Like somebody is just allowed to have money and then bet and then have stuff happening. And the rest of us don't have to approve of him. He doesn't have to get our, oh, he went to Harvard. What a great guy. This stuff can just happen without the world of talking approving. And that feels like it's out of control, right? And then people have this intuition, look, when there's money involved, people could cheat and they could, manipulate things. And then you can't trust places where money's involved. Well, of course, money is involved all the rest of our world too, but somehow we think, yeah, but we've got it under control. Sure, there's money there, but the talking is like managing all that and making sure the money doesn't get out of hand. But if money is straightforward, the central thing, and money can just have force and have effect without talking being the controlling, and then we go, that's just out of control. So this isn't just hypothetical. In our standard organizations, in fact, a lot of the talking is not entirely honest, and people in them kind of know that. So, the standard way an organization presents itself to the world is as if each person is kind of like a scientific decision maker. He's got a spreadsheet. He needs to fill in the cells with the numbers he gets by talking to people. Then he makes his calculations of what decision to do, pass that up. The world of management presents itself as this scientific decision-making process of collecting numbers and filling them in. And each one is just an information aggregator and decider that's making these calculations. That's the presentation we give. And then every speech they give is saying, this is just the results of my spreadsheet. Here's just the calculation I did. That's just, what we're doing right here. Now, if you allow a prediction market to sit right next to those things people are saying with words, claiming they come from their spreadsheet, what they know was that the prediction market won't agree with the words they're saying. And most people in management know that the words they're saying are a carefully calculated impression management strategic choice to inspire people and to push away rivals and to sort of set agendas. People involved in organizations know that the stuff they're saying isn't literally true and isn't the best estimate of the fact, that they have reasons why they think that's the most effective thing to say for organizations.
It's public relations. Yeah.
Right. Of all sorts. And many of it is sensible. We can talk about some of it, some of it that actually makes complete sense. But so it's imagine at the C-suite table, there's all these smart people sitting around having their discussion about, the firm's business and so on. And say you put an autist at that table, somebody who just knows the company really well, but has no clue about social skills. They just have no idea what anybody wants to hear, what anybody's agenda is. So whenever a subject comes up, they just blurt out their best expert, knowledge on the topic. That's going to be really disruptive at that table. Why? And so they won't let that person sit at that table very long. They might become a good trusted advisor to somebody who sits at the table. They will not be allowed to sit at the table and just blurt out whatever pops in their head. That just won't happen. But that's what a prediction market is.
Right. So
a prediction market has no social savvy. It has no idea what anybody wants to hear and what anybody's agenda is just going to blast out every piece of information it gets, regardless of who wants to hear it or how that would disturb anybody. Right. And that's what it's just doing all the time. It's very disruptive to the usual process.
It's just giving people an opportunity to aggregate truth, and it's telling that truth without reverence to whose feelings might be hurt. I think something else you said that I want to underscore from that answer is that talking, verbal communication, physical, nonverbal communication is something we're very familiar with in our society. However, like you're saying, these markets really are a way for people to articulate themselves and to speak in a different language, right? Which is the language of capital. And that's a very powerful thing to unlock. Right. When they don't need to ask anyone's permission, they can do it themselves organically. So I can definitely understand why that makes people uncomfortable, or certain leaders, let's say, uncomfortable. So I just wanted to give that context to the audience. Recently, especially in crypto and digital assets, we've seen a big rise in popularity of prediction markets, things like Polymarket, Kalshi, where users are betting on things like the outcome of uncertain future events like elections and so forth. What is your estimation of this been? Do you think this is a net good for society? Do you like these prediction markets that you've seen? What would you like to see change? What are your thoughts on this general trend that we've seen in the market?
Okay, so if you go back centuries, certainly a century, I don't know if most people know, roughly a century or so ago in the United States, there was more money bet in U.S. presidential election betting markets than there was in the stock market at the time. Stock market was small. Most businesses got their investment through banks, not through stocks. And so we've had a long history of there being markets where people traded. And the main two reasons people traded in those markets was, one, you want to hedge risk, and another, you want to speculate. You think you know something, you think you know better than other people, and you want to bet to show that you know better than other people and maybe make some money as a side effect. Okay, so the point is, those two functions of markets aren't the only things markets can do. Another function, as we talked about, was to aggregate information. And that's the new thing that I'm hoping to see explored a lot better. And if you look in, say, Kalshi and Polymarket, it's those two old functions that are primarily being achieved there. That is, most of the people trading or sponsoring markets in Kalshi or Polymarket are still doing it because either they're trying to hedge a risk or they think they have some insight that they're trying to, win out over other people on. The thing I'm most excited about is when this third function becomes prominent and central. And that's not happening so far yet in Polymarket or Kalshi, but it is happening in some of the crypto organizations that are using what I call decision markets or Futarchy to make decisions in the organization. So the first one that started doing that a lot was called MetaDAO. Then since then, some other organizations, including Butter and Gnosis through Futarchy.fi and Seed. There's a number of experiments going on where people are using decision markets to advise decisions in these organizations. And that's what I have hope for, because that's the new purpose of using the markets to get information. And so in this new purpose, the customer is the person who wants the information. There's the one who's paying primarily to make the whole thing happen. And then because of the subsidies they create, other people are willing to participate, not because they want to hedge risk, but because they want to get paid by these subsidies. And then the information that's being asked for is generated, and then decisions get made based on that information.
Most Web3 projects launch a token first, and revenue, maybe later, maybe never. But KGeN flipped the script. $30.6 million in ARR before a token ever existed, thanks to VeriFi. Cash flow positive, growing month after month, and powering 31 million verified users across AI, gaming, and consumer apps. In a market full of hype and empty metrics, KGeN is proving that Web3 can be built on real revenue, real users, and sustainable growth. Want your protocol to scale with results that last? Grow with KGeN today at milkroad.com/KGeN. So I'm glad we got to this point. I think there are a lot of directions I could take this question. The first one, I want to tie this back to the headlines and sort of like a so what thing. And I'd like to ask about the Bureau of Labor Statistics and the labor data. And then also bring this towards the Fed and interest rates. But I want to start with the Bureau of Labor Statistics. There was a huge negative revision in the jobs data that led to Trump firing the head of the Bureau of Labor Statistics. I want to get your thoughts on the data collection methods that they're using there and how prediction markets could help with something like this, where we're trying to get aggregate economic data that we want to have be high veracity, right? Where we're not having huge revisions in the data.
That's the question. Do we want that?
Well, I mean, theoretically, we would like to have good data to make decisions.
Theoretically,
right?
That's the whole point here, right? So just like in most companies, people in management, the words they're saying are not the best estimates that they know privately because they think they have these various things they're trying to do. That's also true in government with respect to labor data or the estimates of cost of projects, of all sorts of things. In government, we create a lot of numbers. We have statistics departments that generate numbers, and then they forecast numbers. We have numbers forecasted for budgets, numbers forecasted for the public. And the people generating those numbers and the people, talking about those numbers and presenting them to the wider public, they all have agendas about what they want people to believe from these numbers. So none of them are purely just trying to get the number to be the most accurate. And most people in this process know that, but still, they present themselves to the world as if they were just trying to get the most accurate numbers. So if you put this autistic market process in the way, you would in fact get the most accurate numbers, and they're not so sure they want that. So for example, many years ago, the US probably still has what's called a missile test agency. This organization puts together missile tests, and these require different organizations in the military and the missile related government agencies to coordinate together. Basically, there's somewhere a missile's launched and it lands out in the ocean. They need ships to be in the right place, and they need planes to be in the right place, and the missile in the right place. So basically, they have to coordinate to get all these things together to make a test happen. And sometimes the test just doesn't happen because some of the parts just aren't ready. So quite often, a lot of money is wasted because tests don't happen that some people got ready for that other people didn't get ready for. So they created a betting market on whether the tests would actually happen. And this actually gave us more accurate information about which tests will actually happen and which won't. And that was able to save money in terms of, bailing on stuff that's not going to happen. But it was quickly scrapped because it made it more clear who to blame about the failures. And apparently it's just more important not to be clear who to blame than to actually know which tests are going to happen. This is just ubiquitous in most organizations, including the government everywhere. You should just notice pretty much all the numbers governments forecast. If they had a betting market on that forecast would in fact be more accurate, and they don't create the betting market. And this is true for all the organizations anywhere you see in the world. Anytime you see anybody forecasting things and there's not a betting market on that, you should ask yourself, why don't they make a betting market? Won't that give us a more accurate forecast? And the answer is going to be, yes, it will, and they don't want it.
Yeah.
They have some reason why they're massaging the forecast to be the one they're showing you.
Right. Yeah. And I think that's, it's kind of an uncomfortable truth to hear said out loud, but I think that there is some value in preserving sort of this gray area and doubt and the ability to kind of
let's talk about the value in organizations of inaccurate forecasts. Let's just be honest and clear about that. Let's go through a couple of those.
Sure. Go ahead.
One, we have data where you have 2 levels of management and 3 total levels. At the bottom, there's line workers, say writing software. 1 level above them, there's the line managers. They manage the line workers writing software. And above them, there are bosses who manage those managers. These intermediate managers are often called to make forecasts about particular projects they might do and how long it'll take, how many resources it would take to make any particular project asked for at the higher level. And these managers differ in their accuracy. At this middle level, some of them, if they give you a forecast, it'll be, right on the money. It'll be very accurate. And some of them are not so accurate in giving their forecasts. And typically the way they're not accurate is they're optimistic. They will tell you they can do more than they actually can. Now, it turns out the higher level managers prefer the inaccurate middle level managers because when they predict they will be able to do something with so much resources and it starts to turn out that they're not going to be able to do as much as they claim they could do, they push themselves and their people to do more than they otherwise would. And the higher level managers prefer the push to the accuracy. That is, you'd rather have subordinates who just do more, even if they don't do as much as they claim, than who do less, because the managers who are accurate in their forecast, they're predicting roughly what they could do if they only tried to a modest degree, not to an unusual degree. And then they won't have to try so hard. And then the ones who overpromise, they will then, as they reach the crunch of not making their promise, they will push harder to get more done. So, and more generally, if you think about, say, a project with a deadline, if you're really sure not to make the deadline or really sure you will make it, you put in less effort than if you're right on the borderline of we might make it if only we just put in a big push here to make the deadline.
Right.
So I remember seeing this in the 3rd Lord of the Rings movie. That's one of the few times I ever watched the director's commentary about it. And they tell the story of how, the director there just asked for a lot of CGI stuff, way more than the previous movies. And then he had this deadline. Look, the movie's coming out on this day. You need all this stuff to be done. Otherwise, we can't release the movie. And he got a lot of work out of people by making them think they might be able to make the deadline, if only if they pushed really hard to make it by the deadline. So managers know this. Managers know they can motivate and get more work out of people if they put them on the edge of uncertainty about whether they'll make deadlines, which means if the truth is you're pretty sure to make it or not, you don't want to tell that truth. You want to hide that truth and make them uncertain.
Yeah, I think there's a lot of wisdom in that. And I think that a lot of people who have managers can attest to the truth of that statement. I want to get your thoughts on something that happened pretty recently. And I know, like you said, you're more focused on broader trends, but something around this gave me some hope. And I want to also tell you a quick story. Like there's a guy named Sergey Nazarov, who's the head of Chainlink Protocol, which is an Oracle network that uses decentralized networks to create information and store that in a verifiable way on chain and give that to smart contracts and so forth. And he talks a lot about transitioning the world from a system of trust to a system of truth, specifically to solve this problem, right? Of when you have to trust all this data from people, they can be massaging it, manipulating it, whatever word you want to use, in order to, achieve some ends that favor them or disadvantage others. And so moving onto the blockchain is a way to transition from this system of trust to truth. To that end, the Commerce Department recently announced that they're planning to begin publishing economic data like GDP on the blockchain, and they're partnering with different protocols, different networks to do this. But this is just an initial step. Obviously, there's a long way to go with this. But do you think that this is a promising trend? Do you think that moving a lot of this economic data and just a lot of things in general on chain onto the system of truth as opposed to trust, do you think that's a direction that we should explore further? Like, what are your thoughts on that as a solution to this like large scale social problem we have of like, I don't know, just like systemic disingenuous and false information?
The chain literally mainly prevents people from editing historical records. But we haven't so much had a problem with people editing historical records for a while. I mean, that's the thing that has, it's part of 1984, say. Part of the novel is the hero edits historical records. And there have been times and places in the world where you can't trust historical records. They, in fact, get edited. But I think in our world today, editing historical records isn't really the main obstacle to truth. So the question is whether the records put on the chain are true, not what was on the chain. So, for example, many organizations, they have votes, and then the vote is on the chain, and then things happen as a result of the votes. But the question is, are the votes reflecting something true or various, politics and manipulation? So I'd more worry about what's on the chain and how you're producing that than whether it's on a chain. I mean, the chain literally, as you know, the main thing a chain assures you of is that the record wasn't changed. A chain is a sequence of records that can't have been changed because you couldn't change that record without changing all the records afterwards. So once you have a long enough stream of records that you trust a lot of it, you know that you trust all the records because they couldn't have changed they couldn't have changed any of them unless they had to change all of them.
Right. Yeah. And so what you're describing is why I think Chainlink is so powerful. Not to talk about one specific protocol or anything, not financial advice, but the way that they get their data network, their data from their Oracle network is through what you're kind of saying, like this decentralized methodology to make sure that the data that they are storing is high quality, verifiable, and unchanged, as you say. I want to, so before we move on to a new topic, I want to ask one more question, just for the joke of it, really. But the markets are predicting with like a 90% likelihood, a 25 basis point rate cut by the Fed in September. I think that the way that we currently make these choices about economic policy or monetary policy is very much reliant on, like we said, like unreliable data, and then just the decision making of a few people in Washington. How could we use prediction markets or change the way that we're setting monetary policy to make sure that we're not chronically behind or off on where we are with monetary policy?
Decision markets, which I talked to you about before, is something that many crypto organizations are now using. Let me just walk through an example and then tell you how it works for the Fed. An example of a decision market would be deciding to fire the CEO of a company based on a conditional stock price. That is, you can set up the market so that you have a value of the company, the stock price, if the CEO stays, and another value of the stock price if the CEO leaves. You can actually just get two different prices from special conditional markets. And then you can compare those prices to say, well, let's keep the CEO if the value of the company is higher if we keep them than if we let them go. That's a key example of a decision market. And the more general process is we need an outcome metric that we think tracks the thing we care about, in this case, the stock price. And then we need discrete decisions, keep the CEO or not. And then we need to estimate this outcome metric we care about, conditional on each of the discrete decisions. And then that's enough to get a recommendation from the market about which decision to take. Okay, so now for the monetary policy, it's a nice example of this because we have a nice discrete decision. Every time we raise or lower interest rates, there's a limited number of options. There's at most 5 different options we can be considering of, raise the interest rate a lot, a little, do nothing, lower the interest rate a little, lower it a lot. There's not very many options. And so for each option, we could ask a market to estimate some consequence. And then the key question is, can we agree on the consequence we care about for macro policy? And it turns out we can. That is, the literature on macroeconomics doesn't disagree that much on the outcome we care about. It's some simple weighted average of future unemployment and GDP growth. And it doesn't really need to have much else as long as you estimate that in, 5 years later or something. And then we could just estimate those two quantities, some weighted average of them conditional on which interest rate option we pick. And that would be a decision market that could replace the Fed board in making these decisions. And arguably, it would do at least as good a job, because we have all the rest of this literature saying that when we compare prediction markets to other things, they do at least as good a job in forecasting. So almost all the expertise of the Fed is to try to make the judgment of the connection between whether to raise or lower interest rates and these long-term consequences we all agree are the consequences we care about. And that's a perfect application of Futarchy, basically. We could just do Futarchy directly for that decision.
Awesome. Just so the audience is aware, and I'm clear on this too, I looked this up before, but what is a Futarchy?
It's the same as the decision market. So I just gave you this example of the CEO. So the stock conditional on keeping the CEO, stock conditional on getting rid of the CEO, that is a decision market. It's just decision conditional estimates of the outcome you care about.
Right. And
that's what
hierarchy, monarchy, those words mean power within a
kind of
right. Exactly. Right. Exactly. So okay. I just want to make sure that
I tried to say a future form of government was the way I named it a long time ago, but the name, it's kind of too late to change it. So
yeah. No, we've gone down this road a long way with that. We'll make it work. But I just wanted the audience to understand, like, the idea that we're talking about is a different way of investing power and of decision making, such that we are all able to contribute in a more direct way, in one that doesn't revolve around verbal communication. I wanted to ask one other thing about this, which is that, so what we've been discussing here are potential reformations to how we make decisions at a social level, how the Fed makes decisions. Right now, there's been a lot of conversation around reform of the Federal Reserve from the Secretary of the Treasury, from other people in this administration. And there's this kind of like worry that the Federal Reserve is going to be losing its independence. I just wanted to kind of get your thoughts on this as somebody who is a student of history and an economist. What do you see as sort of like likely outcomes from this? Have you been paying attention to this? Do you think the Fed is going to lose their independence? Like, what are your thoughts on this whole conversation?
So I just proposed a pretty dramatic reform of the Fed in this last few minutes. So I would therefore like if people would consider changing the Fed, because I think there are ways to make it better. But the basic fact of especially America governance for the last 250 years is that we have not changed very much for a long time. So most of the rest of the world has made much more dramatic changes to their institutions of governance, their election institutions, their government agencies, than has the United States. And the reason you can see in this is happening in this case too, whenever someone proposes changes, then that's proposed usually by somebody who's in power. And then the other side says, oh, they're trying to change that now because they're trying to undermine the protections that the current system has had for you. You can't trust them while they're in power. Wait till we're in power and then let us change the system. And you can see, that just means it never changes, right? So only if the two sides would get together and have some sort of, conference committee summit where they agreed together on a change, but they don't want to do that. Because they're hoping that they're going to be in charge next time, and then they would get to change it more their direction. So unfortunately, the United States just has not changed its institutions very much for a long time, compared again to most of the rest of the world. We're sort of locked in. But it's also interesting that there's just very little emotional passion there. So if you look at people's passion about politics, the things they're most passionate about are the things that align with these cultural fights, where there's an us and a them, and you're fighting for us side and those against those evil guys. People love those fights. So look, anything Trump's pushing and the other side is against, everybody's all over that. When you start to talk about the structure that this whole thing takes place in and the larger institutions, people just get bored really fast. They just can't be bothered with that discussion. So for example, in the last half century, most governments, when they made major changes to institutions of democracy, they picked proportional representation. And there's a literature that suggests it's just a better form of democracy than what we started with 250 years ago. But you know what? Nobody wants to make those changes here because, first of all, somebody loses, somebody wins, and the losers don't want to allow it. But then the public just has almost no passion for any of these institutional changes. And that's a problem for the institutional changes I'm proposing too. We'll have to wait till some period where there's more openness or passion, or somehow it becomes a us-them thing, in which case one party gets in control and they have enough power to push it through and the other side hates it, but somehow change happens anyway.
Well, I hope it doesn't become an us them thing. I think we've seen people from the digital asset space and the crypto industry, I think, are generally familiar with this, though, because, there was Operation Choke Point 2.0 in the Biden administration, and now the Trump administration is very friendly to digital assets. And when it becomes this sort of political football and like a cultural war that people are only interested in because the other side is opposed to it, I think that's like toxic and unhealthy. And sometimes you do get changes, but they're not usually in a positive or generally constructive direction. And yeah, I appreciate the feedback that these are boring subjects that most people will tune out on. But part of what I'm interested in doing with this conversation is to draw people's minds and attention towards what is possible and to just make them aware that, hey, there's a better mousetrap that we could build and it wouldn't really be all that hard, right? So we have the tools to make these things better. I want to just kind of close with this. Like we're going into the second half of this year. Obviously, rate cuts haven't come yet, but a lot of people are predicting that they are. Just from like a macroeconomics perspective, what should investors be watching for as we go into the end of this year? What's the most important thing for them to pay attention to? Is it,
so I'm going to say a boring thing,
Go ahead.
which is just on macro things like this. We have a number of financial market prices. There are, interest rate futures and there are options on these. And those give a full probability distribution over all the possibilities you're thinking about. And you should just believe those probability distributions. And if you think you know more than those distributions, what you should really do is trade in those markets, make money on your insight. And now all the rest of us can benefit from your insight. But if you don't have any special insight, just look at those distributions and that's what you should believe. And you shouldn't listen to some guy on a podcast like me telling you something different than the market price out there. You should say, look, Robin, if you know better than the price, you go trade and fix that and make your millions. Why make you listen to me on the podcast? That's just irresponsible of me to pretend I know more than the market price here.
Well, this has been a lot of fun. I've learned that I'm boring and I'm inefficient and I should shut up because too much talking is bad for everyone. But no, look, I appreciate the candor with a lot of these answers. And this has been a really fun and enjoyable conversation for me. I feel like I've learned a lot. I hope the audience has too. There are a lot of things I've been wanting to ask you about that I just did not get to, and we're not going to have time to today. So we'll probably have to get you back on again.
If you're in the mood.
We would, well, if we haven't canceled this show because it's too boring and a waste of time, then we might have to do that. One final question: where can we send people to find more of you and your work online?
I'm Robin Hanson. So fortunately, I'm the most popular Robin Hanson on the internet. So if you just search for me, you'll find me.
Thanks, Professor. Thanks for being here. I really enjoyed it. Thanks for being on Milk Road Macro. All right, great. Thank you all for joining us. Until next time. Stay safe, stay educated, stay bullish, and we hope we'll see you on a future episode of Milk Road Macro. Thanks for being here, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.